Friends, how are you all? Good morning, Zaminathan. Good morning, Geeta. Lavanya. Okay, so a warm welcome to all of you to this preliminary session on the topic of advanced capital budgeting. We're going to cover this topic by way of first revising the concepts and then maybe by looking at certain MCQs, which is based on case scenarios. Okay. So we'll just quickly recap recap the concepts of advanced capital budgeting, and then in the next part of our session, we'll be taking up the MCQs based on the case scenarios. Okay, so let's just quickly try to recap. We know what are the things that we are going to cover in this particular topic. That's going to be like, first up, impact of inflation on the capital budgeting process. So basically, the impact of inflation is something that we're going to look at. Second part is what are the risks that is involved in the capital projects, right? The risk could be analyzed by using statistical tools, which will be probability, variance, standard deviation, coefficient of variation, certain conventional techniques, which is risk-adjusted discount rate, certainty equivalent, and other techniques like your sensitivity analysis, scenario analysis, decision tree, simulation analysis. And then we had the adjusted present value as the last concept. Now, let us look at the first impact, which is the impact of inflation. So what we have already observed is there may be two types of cash flows. One is a real cash flow, another is a nominal cash flow. The real cash flow is like when you are calculating the future cash flows based on current price level, right? So if the selling price is 10 and you have these units to be sold in future, so you will get the sales figures as units multiplied by the selling. So every time the units are multiplied by the selling price, and that's what you get it as a real cash flows. Okay. कैमरा का इशू है, तो ये हटाऊंगा तो फिर कैमरा नहीं. ठीक है सर. हाँ, कैमरा का आएगा सर, क्योंकि मेरा इंटीग्रेटेड है ना, तो वेबकैम थोड़ा खराब है, तो पता नहीं क्या हो गया. तो मैं डूइंग इट फ्रॉम आईपैड, सो ऐसा रखूँ कि इसको हटा दूँ सर. See that the sales, it could be at the current price levels, right? When we look at the units and the selling price, we calculate the sales at the current price level, which is also called as the real cash flows. And if you're going to add inflation to that, okay, if you're going to add inflation to that, that's going to be called as the nominal cash flows. Now, as obviously quite a simple idea that your real cash flows are going to be numerically smaller as compared to your nominal cash flows. So real cash flows are going to be discounted at real rate of return, and nominal cash flows are going to be discounted at a nominal rate of return. And quite obvious, your real rate of return is going to be lower than the nominal rate of return, because nominal rate of return is also going to include the impact of inflation. Okay. So when we look at the relation that we have between real and nominal rate. We have already learned about this. I'm just recapping this particular concept that it's going to be 1 plus real rate into 1 plus inflation. So compounded effect of real and inflation is going to be the overall nominal rate. So 1 plus real rate into 1 plus inflation is going to be equal to 1 plus the nominal rate. Okay. So 1 plus real into 1 plus inflation is going to be called out as the 1 plus nominal rate. So obviously, if we have the real rate and the inflation, I can get the nominal rate. If I have the nominal and inflation, I can even get the real rate. Now, the fundamental thing that we have over here is, if we have real cash flows needs to be discounted at real rate of return. And if it is inflation adjusted cash flows, which is nominal cash flows, they needs to be discounted at nominal rate of return. Okay, so real cash flows at real rate of return, nominal cash flows at nominal rate of return. Okay, but one thing that we need to be very particular about is the impact of inflation on depreciation. So, when we look at the cash flow after tax component, we generally have revenue minus cost minus depreciation into 1 minus T plus depreciation. Okay, and then when we just open it all, it's revenue minus cost into 1 minus T plus depreciation into tax rate. Okay, so this particular part, which is the tax saving on depreciation, ideally there is no impact of inflation on it. So depreciation into tax, this particular portion, there is no impact of inflation on it, because government doesn't allow you depreciation on at a higher rate when you go when you're increasing when the cash flows are happening in future due to savings in depreciation. So daily savings in depreciation is a constant figure. There's not going to be any inflation impact. So we need to break our CFAT into two parts and adjust only this portion by the inflation and not having any impact on the other portion. Okay, so that's one thing that we need to be careful about. Then let's go for the next part, which is evaluating the risk involved in a capital project by calculating expected value and standard deviation. So this expected value, standard deviation, coefficient of variation comes in when you have a variance or when you have a variety of outcome and there's a probability assigned to that. Okay. And there's a probability assigned to that. So price of share in 1 year, it would be like 500, 400, 350, 300, 250. So these are the prices that we have. And then the probability. So probability multiplied by the prices. Obviously, the total of that is going to be the expected. So expected price is computed as summation of P into X. So expected price or expected value is computed as summation P into X, which is probability into the price. Okay. And variance is going to be computed as probability into X minus X bar, because X minus X bar is denoting the deviation or the variance, and then the square of it. I mean, X minus X bar is the deviation that we have, and we do the squaring of it. So that the positive and negative impacts are nullified with each other, and then you multiply it with probability. The standard deviation of X is going to be square root of variance, which is square root of P into X minus X bar square, which is square root of variance, which is 85.84. Coefficient of variation is standard deviation upon expected value, right? So standard deviation was 84.84 and then divided by the expected value. Now remember, standard deviation as such itself is not going to be an indicator that a project is, having a higher level of risk or lower level of risk as compared to the other. In fact, it can be used only after calculating the coefficient of variation. So if you want to compare standard deviation of, the risk of two projects, then we should be comparing the coefficient of variation. And we should be comparing the coefficient of variation and not the standard deviation as such. Standard deviation in isolation, it's a measure of risk, but when you want to use the comparative, I have to use this coefficient of variation, because every project is going to have a different expected value. So for a given level of expected value, what's the standard deviation? That is what we are going to look at, right? So that's your coefficient of variation. Okay. Then, uh, then we have seen a couple of questions to the same aspect, expected NPV. Okay. One important part is when you want to calculate the variance of NPV. Remember the variance of NPV means what is the variation that we have in the NPV? That's going to be simply variance of cash flow in year one upon 1 plus risk free or 1 plus risk 1 plus rate. It's going to be square because variance is a square term, right? And second, in fact, all the variance values needs to be discounted by the square of the 1 plus r, square of the compounding factor. Okay. So when you want to calculate variance of our NPV, we need to take the total of all of them by dividing it with 1 plus r square, 1 plus r raised to 4, 1 plus r raised to 6. Okay. That's the thing. And then coming to the next part, which is about risk adjusted discount rate. So risk adjusted discount rate is essentially, risk free plus the risk premium. Now, can you tell me on what value is the risk premium going to depend? Risk adjusted discount rate is risk free plus the risk premium. But still, I'm just asking you on what value does your risk premium depend, or how is your risk premium determined on what basis? What basis is the risk premium determined?
Based on the risk of the asset.
Based on the risk, yes, definitely. Based on the risk. Higher the risk, higher would be the discounting rate. Now, risk could be, maybe coefficient of variation, maybe standard deviation, or maybe some other operational risk aspect also, right? So that guideline we need to be having before we go ahead with the calculation of the, risk premium. Now, of course, this risk premium aspect is also going to be covered in the topic of portfolio management, in which we'll be looking at various types of risk based on standard deviation, based on beta, based on aversion of investor. So all those aspects are going to be covered there. Now, we know that risky cash flows need to be discounted at risk-adjusted discount rate. Risky cash flows needs to be discounted at risk-adjusted discount rate. And secondly, what if I just do one thing, sir? If there is a certain amount of cash flow, I would like to know, what proportion of that cash flow is certain or sure. What proportion of that cash flow is certain or sure? So whatever is the sure component of the cash flow, whatever proportion we have, that's going to be certainty equivalent. Okay, so expected cash flows needs to be multiplied by certainty equivalent to get certain cash flows. Expected cash flows multiplied by certainty equivalent is going to be certain cash flows. Okay, so 15 lakh, if it's expected cash flow, and we have the certainty equivalent of 0.85, it means 85% of these cash flows are very much certain or sure. And if we are taking the certain cash flows, the sure cash flows, what should be the discount rate for these cash flows then, guys? What should be the discounting rate? Risk-free rate, right? Because the cash flows are certain, the cash flows are sure. So we need to discount it. Right? Sorry, the cash flows are certain or sure, then we need to discount it at the risk-free rate. Okay, we need to discount at risk-free rate. Then next is the next aspect of our understanding is, measurement of risk is sensitivity analysis. Now, what do we do in sensitivity analysis? We are going to measure the sensitivity of the output, which is NPV, right? So sensitivity is going to be for the output, which is the NPV. So sensitivity analysis, we can say for the output, which is your NPV, we want to see for a small change in your input, for a small change in the input, which is input cost, initial cost, or units, or selling price, or variable cost, or fixed cost. So for a small changes in these units or inputs, what is going to be the impact on the NPV? What's going to be the impact on the NPV? So that's what we want to compute. Output is going to be NPV. The initial cost is 400. And then when you have a 2.5%, let's say adverse impact, I want to see that if my input changes by 2.5%, or units in changes by 2.5%, or selling price changes by 2.5%, or variable cost changes by 2.5%, or fixed cost changes by 2.5%, we will see what's the impact on for a 2.5% change in your inputs. You want to see what's the impact on the NPV, by what percentage is your NPV change. So you recalculate the NPV again and then see what's the impact. So for example, over here, we computed for each of the change, like initial investment was changed, selling price was changed, variable cost was changed, fixed change in your input. So like we got this as a sensitivity factors. Like if there is a 1% change in the input, what's the impact on my NPV? So percentage change in NPV divided by percentage change in input. 7.43% my negative 7.43% divided by 1%, right? So that's going to be like divided by 2.5%. So we find that out of these, the most sensitive one is variable cost and the units. No, sorry. The most sensitive one is my bad. It is a selling price, because you see a small change in your selling price, like 1% change in your selling price, is going to lead to 9.93% change in the NPV. 1% change in the selling price is going to cause 9.93% change in the NPV. Okay. Then scenario analysis. This is again another type of sensitivity analysis technique, in which we're not looking at changing one of the variables, not looking at changing one of the variables. Rather, what we're looking is multiple variables creating, a particular scenario. Like let's say, you are saying that the selling price may change by 2.5%, or input cost may change by a certain percentage. So you create a scenario, and then you create multiple scenarios. Like in this case, we have three scenarios: worst case, most likely, and best likely, right? And then in each of these scenarios, we calculate the NPV. So I say that worst come worst possible, I can have the NPV as a negative 110. In most likely case, it's going to be 100.85. And in the best case, it is 311.85. Okay. So 110.15, 100.85, and 311.85. So these are the possible scenarios. So you see the wide variety of outcome that's possible. Okay. Now, we may have something like, decision tree analysis, where you check whether a particular test is, if suppose a test is performed, then whether it will be successful or not, whether to perform the test or not test, you create this sort of possibility. So let's say, if you do a test, you need to spend 2.4 lakhs. And if you're not doing any test, of course, there's no cash flow. If you perform a test, if you're performing a preliminary test, then you're having a success chance of 0.5 and a failure chance of 0.5. If there's a success chance of 0.5, you need to invest further to 20 lakhs. And again, D, if there's failure, you need to invest further 12 lakh. Right? So what we can see is that, let's say, investing 20 lakh over here, let's say investing 20 lakh. If you invest after success 20 lakh, then you're likely to get a perpetual cash flow of 4 lakh per annum. So the net benefit amount is going to be what? Present value of perpetual cash flows, which is 4 lakh divided by 10%, minus 20 lakhs. So we see that the net benefit at this node after the success, it is 20 lakhs. And if it is like, if you don't do any sort of investment, then there is no benefit coming out of it, right? So you can see investing makes sense because it's going to give a positive NP. Same way, decision node D, whether to invest or not. Let's say we look at like investing 12 lakh will give us a perpetual cash flow of 1 lakh till perpetual. So if I look at the net benefit, that's going to be present value of perpetual 1 lakh. Okay, so 1 lakh divided by 0.1 minus 12 lakh, which is minus 2. And then invest nothing, which is net benefit. Invest nothing, net benefit is 0. So don't invest in any node D. Don't invest over here then because it's leading to a negative NP. Okay, so I can see at decision node C, if you make an investment with an NPV of 20, probability 0.5, I see that the expected NPV is 10. So of course, if we do the test, I'm getting a benefit of 10. And then of course, at decision node A, whether I should be really investing or not, I say 7.6 lakh is my net benefit. I should be making an investment. So this is like the case where we are doing simple, the backward calculation, like, looking at what's happening in future and then bringing it to present value or current levels. Okay. One of the cases. Then another technique that we have learned in advanced capital budgeting is something called as a replacement decision. But I mean, we need to decide whether to replace an old equipment with new one or not. So for that, we need to compute the incremental cash flow, just like any other, just like any other benefit or just any other technique of capital budgeting. We always look for the incremental cash flow and not the accounting or any other cash flow. So incremental cash flow that we get from a new system, that's going to be computed as what? Incremental sales, any incremental savings that you have, minus any incremental expense that you have, plus tax savings on the incremental depreciation. So we have incremental sales, incremental savings, incremental expenses, plus tax savings on the incremental depreciation. Okay. Also, when we're looking at deciding whether when should we replace a particular equipment, we simply look at the multiple cases. Let's say if we are going to replace it in 1 year, if you're going to replace it in 2 years, if you're going to replace it in 3 years, then we say that if you're replacing in 1 year, what's the NPV? If you're replacing it in 2 years, what's the NPV? If you're replacing in 3 years, what's the NPV? And then we calculate the equivalent annual cost by dividing the NPV with the annuity factors. Dividing the NPV by the annuity factors. Okay. Then the last concept that we have that we're going to revise, then we'll start with the MCQs. It's called as the adjusted present value. So adjusted present value is an advanced level of capital budgeting analysis in which we take reference from model. So in model, we have like, CA interlevel, we have learned something like this. Value of levered firm is going to be equal to value of unlevered firm plus debt into tax. Okay. So value of levered firm is equal to value of unlevered firm plus debt into tax. Firm is equal to value of unlevered firm plus debt into tax. Additional benefits to levered entity is tax savings due to interest payment. And of course, the annual benefit that we have is taxed into interest payment. So we used to see that present value of future tax savings due to debt was interest into tax divided by KD. And we say that interest upon KD is nothing but the value of debt. So value of debt into tax rate. Adjusted present value is simply going to be the best case, the base case PV plus present value of tax saving on the income. Now we can obviously calculate the base case present value is by assuming that the project is fully funded by, and then we look at what is the tax saving happening due to the interest. So present value calculated assuming project is funded by equity. right? That's your base case PV. So initial cost is 10 lakh, K is 20%, KD is 15%, cash flow after tax is 3 lakh. That's going to be there till perpetuity, and tax rate is 30%. So base case NPV is present value of inflow minus present value of outflow, discounting at 20%, which is your K. Okay, so 10 lakh divided by 20% minus, so 3 lakh divided by 20% minus 10 lakh, that's going to base case PV is 5 lakh. Interest expense per annum is, of course, if you're going to fund this by way of debt, you're going to say, 10 lakh into 15%, which is 1,50,000. So tax saving that we have is 45,000, and present value of tax savings is 45,000 divided by 15%, which is 3 lakh. So now adjusted NPV is base case plus present value of future tax saving, which is 5 lakh plus 3 lakh. That's going to be adjusted NPV is 8 lakhs. Right, so adjusted NPV is 8 lakhs. So 5 lakh plus 3 lakh, that's going to be 8 lakhs. That's your adjusted NPV. Okay, so you calculate the adjusted NPV by taking the impact of debt financing and the tax savings that we get on it. Okay, now let us get started with MCQs, guys. Few MCQs, few case scenarios and their respective MCQs that we're going to discuss. Okay, and then maybe we'll take up certain other questions for discussion also. Now, before we look at the discussion of it, just go through the question for a minute, guys. Just go through the case scenario for a minute. Okay. Pre Limited is considering a new project with the following details. Initial project cost is 4,80,000. Annual projected sales is going to be 4 lakh. variable cost which is projected is 1 lakh 60 and fixed cost that is projected is 60,000. Project life is 4 years. Cost of capital is 10% per annum. Consider cumulative present value factor for 4 years at 10% as 3.169 and 11%. Ignore the depreciation on initial project cost and taxation, and you have to choose the appropriate answers. Now, if the initial project cost is varied adversely by 10%, what's the percentage change in NPV? Then if cash flow is varied adversely by 10%, what's the change in NPV? And if the cost of capital is changed by 10%, what's the percentage change in NPV? Okay. So would you like to solve these MCQs first, guys? And then we'll discuss, or shall I give you the solution? Maybe we can take 2 minutes, maybe five or 10 minutes, just scribble and would you like to solve it? Yeah. Would you like to try, or shall I just take it up? Yeah, Lavanya?
We will try, sir.
You'll try? Okay. Just take around 5 minutes, guys, and try to solve it quickly. Just try to scribble, and you no need for any formal solution as such, because this is just an MCQ. Okay, one, it is C. Solve all of them, and then we'll see, we'll discuss which of them is correct.
Sir, can you zoom in a bit, sir?
Jack Bandhuji, is there any issue?
Oh, they're just trying the MC. So just give it 5 minutes to that.
Okay.
Is done. One is C. Okay. Let's see whether the first question is at accurately 53.09. So for that, we need to have this data. Let me just take the data over here. So we're looking at calculating initially. If initial cost is varied by 10%, what's the percentage change in NPV? So let's first compute the original NPVs. The initial project cost is 4,80,000. Annual projected sales is 4 lakh. Annual projected variable cost is 1,60,000. And annual projected fixed cost is 60,000. Project life is 4 years. Cost of capital is 10%. Ignore depreciation on initial project cost and taxation, and then calculate it up to 2 decimal places. Okay. So first we need to get the original NPV or the base case NPV. So we have the project cost as 4,80,000, project sales as 4 lakh, right? So let us say CFAT calculation. We have the sales, or let me just do the CFAT calculation as sales is 4 lakh minus 1,60,000 is a variable cost minus 60,000. So this is what? 4 lakh minus 1,60,000 minus 60,000, 1,80,000. So that's your cash flow after tax. 1,80,000. Okay. And we can definitely get the PV by simply multiplying this 1,80,000 with 3.169 and then further subtracting 4,80,000. This into 3.169 minus 80,000. So this is the 3,420 is the base case NPV, original NPV, guys. 90,420 is the original NPV. Okay. Right. Now we are going to change for this case, we are going to change the initial project cost by 10%. So revised NPV for a 10% change in initial project cost. So CFAT remains the same. Okay. But the NPV is going to be now what? 1,80,000 into 3.169 minus 4,80,000 into there's a change of 10%. So into 1.1, 1,80,000 into 3.169 minus 4,80,000 into 1.1, 42,420. Right. So we want to know what's the percentage change in NPV happening. Percentage change in NPV is percentage change in NPV will be 3,420 minus 42,420 divided by 90,420. So 90,420 minus 42,420 divided by 90,420 is 53.09%. So as per that, the option is option C. Did you get it, everyone? Option C.
Yes, sir.
Yeah. Okay. Now for the second part, we say annual cash flow. Annual cash inflow is varied by 10%. So I need to compute the revised CFAT. Revised CFAT. Revised CFAT is going to be by reducing the annual cash flow. So reducing this annual cash inflow by 10%. So this is going to be 4 lakh into 0.9. So 4 lakh reduced by 10%. The rest all 1,60,000 and 60,000. That works. We have 4 lakhs into 0.9 minus 1,60,000 minus 60,000. So that's the revised CFAT is 1,40,000. And then we can get the revised NPV based on this. Revised NPV will be 1,40,000 into 3.169 minus 4,80,000. 1,40,000 into 3.169 minus 4,80,000. So new NPV that we have is, one second, there's some issue. The question says if annual cash inflow is varied adversely by 10%. So by 10%. PV is no, some issue here in the calculation, I think.
Sir, we are getting negative NPV only, sir, in this.
Getting negative NPV?
340 is correct only, sir. Positive.
Sorry.
The NPV become positive of 36,340. That is correct only. Not in negative sign.
Profit is less than cost.
Our cost is 4,80,000. Correct only.
But profit we got 443,660, right?
443.
Yeah, 443,660. Yes.
Which one? Okay, I mean the cash inflow you're seeing.
Yes, sir.
This is okay. So cash inflow. I think this should be on what? Let's check. 1,80,000 into 0.9, 10% adverse variation. If we do this as 1,62,000. Yeah, so there is a change over here. If annual cash, this actually it's not annual cash inflow as such. We're looking at the net annual cash inflow. Okay, because we're saying the cash inflow, so we are not looking at the change in sales, but the change in the overall, cash inflow. So therefore, the revised CFAT is going to be like 90% of the original. 1,80,000 into 0.9, 90% of the original. And then we say this is the revised NPV. Now, of course, from this we can get the percentage change in NPV. Now the percentage change in NPV can be computed as 90,420 minus 33378 divided by 90,420. 90,420 minus 33378 divided by 1,420 minus 33378 divided by 90,420. So it is 63.09. Do we have the option 63.09? Yes. Option C. Option C is 63.09%. Okay. Have you done the third one?
Yes, sir. But I have one doubt on this. On the second question, if annual cash inflow, but they are not taking not about the inflows, which means that we can reduce it. But they are talking about only the cash inflow, which means only sales revenue only.
No, because sales revenue is not only cash flow, right? Which sort of it should be, the net annual cash flow should have been the word accurately.
That's okay. I understood, sir. The thing is that if you look at cash flows, if they put flow, yes, if you mentioned, then we can adjust the sale with the cost. But here the question is not
Exactly.
specifically cost.
Yeah. That's a bit of confusion.
Yeah, that's a bit confusion over
If we
here.
add the word net over here, then all the goes away.
Exactly. Thank you, sir. Yeah.
The third one, which one is the option? Have you got the answer? Third one?
13.14. C.
13.14%.
14%.
Okay. So how did you calculate the new NPV? Because our discounting rate is 10%, and they're saying that change the discounting rate by 10%.
10%. We have to
Going to
take
be the new
11%
or
for
the
discount
revised
cash.
cost of capital. Revised cost of capital is cost of capital is
11%.
adversely by 10%. So revised cost of capital will be 10% into 1.1, which is 11%. So we calculate the new NPV by using this 11%. So we calculate the revised NPV then. Revised NPV will be the original cash flow of 1,80,000 into present value annuity factor at 11% minus initial project cost is 4,80,000. That 80,000 into present value annuity factor at 11% is 3.103. 4,80,000. So it is like 78,540. So percentage change in NPV. Percentage change in NPV will be 90,420 minus 78,540 divided by 90,420. So 90,420 minus 78,540 divided by 90,420. 13.13%. Yeah, 13.14%. Yes. Option C is the accurate answer. So don't be under an impression that every time you're going to get the answer as option C. That's by default, or we can say by chance it has happened over here. Okay.
Yes, sir. But because
Yeah,
of the
so
second question, I got stuck, sir. Annual cash flow, we are getting negative NPV.
correct. Because that was something bit of confusion.
Yes.
Okay. Anyway, so let us go for now the case scenario 2. Same lines, would you like to try it first? Would you like to try it first, guys? Yeah.
Yes, sir. But it would be good if you can zoom in a bit.
It would be good if I could.
Zoom in a bit, sir.
Okay.
It is not that much clear.
I think you can zoom it in your screen also, right? Because if I zoom in, then the data, will not have it in the. Can I zoom it at your screen level or no?
Yes, sir. Now it is okay, sir.
Giving you 5 minutes time. Try to solve it quickly. ABC Limited plans to invest ABC Limited plans to invest 16 lakh in new unit. The project is expected to have a useful life of 4 years with no salvage value at the end of its life. The annual depreciation charge for the project is 4 lakh. Revenues and costs are provided. ABC Limited is subject to a corporate tax of 60% and cost of capital for the project, including inflation premium, is 10%. So this is including. So this 10%, is it nominal rate or is it real rate? The cost of capital, which is 10%, is it nominal rate or is it the
Nominal
real
rate.
nominal rate? Because it is
Nominal
including
rate,
because including the inflation premium, right? The depreciation provides a tax benefit and inflation rates for revenue and cost over the project's lifespan are as follows. So year 1 and 2 we have, and also the 3 and 4 data, we have the revenue inflation and cost inflation. From the given information, choose the correct answer. Okay. First one, inflation adjustment of revenues and cost is required mainly because why do we need to adjust the revenue and cost? First option is cost of capital includes inflation, tax rate is high, depreciation is constant, project life is short. Of course, the correct answer is cost of capital includes inflation. Right? So correct option over here is option A. Second, if inflation were ignored in cash flows but included in discount rate, the project NPV would be. So if inflation were ignored in cash flow, but that's included in discount rate, then the project NPV would be like inflation is ignored in cash flow. So you are taking the real cash flows. But inflation included in the discount rate. So discount rate will be the nominal discount rate. The project NPV will be overstated, understated, correct, or is it going to be zero? It's going to be understated, guys.
yeah, yes, sir. I feel and understand it. Correct.
Understated, yes. Because when you say you're taking the real cash flows, so compared to your nominal cash flows, your real cash flows are smaller. And then we say the discount rate, nominal cash flows. Now, if you are going to use like nominal cash flows need to be discounted by nominal rates. And if you're going to discount the real cash flows also by the nominal rate, then quite obvious that when you compute NPV, NPV of the real cash flows is going to be lower. So this is going to be understated. Okay, so it's a case where you're going to say that it's going to be understated. Okay. Okay. Are we clear? Why is it going to be understated, everyone?
Yes, sir. Inflow will be lower when you are discounting at higher rate.
Because if cash flows are lower, right? So if cash flows are lower, then of course it's going to be discounted at a different rate. So if it's discounted at a higher rate, NPV is going to be smaller. Then, which of the following cash flows is not affected by inflation directly? So these cash flows are not affected by inflation.
Depreciation.
I've covered this already. Depreciation, right? Correct answer is depreciation because depreciation is a constant figure. Whatever is the depreciation, that's going to be historical base and not on the inflation or the real base, right? Okay. before we go for the next question, we have like what four case scenario. But this case scenario, the second one, can be an independent question also. It lets it's looking for investment. These are the cash flows that we have, revenue and cost, ignoring inflation. So what are these revenues and costs? What are these revenues and are they real cash flows? Are they real cash flows or nominal cash flows?
Real cash flows.
These are the real cash. Okay. Now, discounting rate given is nominal discounting rate, right? Discounting rate that we have is the nominal discounting rate. Now, can you just try to solve and get the NPV of this question, guys? Can you calculate the NPV for this case? Yeah. What we need to do is I'll just give you a guideline and then you tell me whether you can do it. You need to, of course, convert these real cash flows to nominal cash flows, all your revenues and costs. Okay. So you'll get the real cash flows. And then you need to subtract tax out of it and also add the tax savings or depreciation without any inflation adjustment. And then use 10% to discount it. Right? So can you solve this? Can you solve this or no? The first step, I'll just write down the steps over here. First step is to calculate the nominal cash flows. Okay. Second is our nominal cash flow will be also you need to take into account. This can be computed. Nominal revenue minus nominal cost. Right. Subtract. Add, we can say. And this needs to be nominal revenue minus nominal cost. It needs to be multiplied by the tax rate, multiplied by 1 minus t. Sorry. Multiplied by 1 minus t. Plus, you will say depreciation into tax. So this is the first step that you do. Calculate the nominal cash flow for each of the years. And then second step would be discount your nominal cash flows by 10%. So can you calculate the NPV for this second case scenario question? Can you calculate? Yes or no? Hello. Can you hear me, guys?
Yes. Yes.
Yeah. Okay. So first try to get the nominal revenue and the nominal cost. Subtract it for each of the years, right? Or else I can also provide you sort of a format also for this. If you want, I can just give you a format that will be maybe some sort of helpful for you. The year that we have. Right, so year 1, 2, 3, 4, 5, 1, 2, 3, 4, 4. The other 4 revenues that we have. Now, for each of these revenue, we can say revenue into 1 plus inflation. That will be your nominal revenue. Nominal revenue. Then we have the cost. And then I need to also multiply the cost with 1 plus inflation to make it nominal cost. Okay, so revenue into 1 plus inflation, cost into 1 plus inflation. So revenue is converted into nominal and even cost is converted into nominal. Okay.
Sir, when considering inflation for second year, do we need to consider both the years, sir, first and second year?
Yes, you have to consider the cumulative impact of inflation for all the years. Right. For first year, it will be the first year into 1 plus inflation. For second year, it will be first year inflation as well as second year inflation. Right. So, for example, in case of revenue, it is 12 lakh, then it is 14 lakh, 16 lakh, 14 lakh, 16 lakh, and again 16 lakhs. 12 lakh into 1 plus inflation is what? 10% in the first year. And for second year, it's going to be this into 1.1 into 9%. So 1.09. This is 1,60,000 into 1.08, 1.1 into 1.09 into 1.08. This is your inflation. And then we have the 7% number also. It's going to be 16 lakh into 1.1 into 1.09 into 1.08 into 1.07. These are the nominal revenue numbers. And then what is going to be the cost? Write on the cost and get the nominal cost, guys. Okay. Try to get the nominal revenue, nominal cost, subtract it and get the nominal cash flows. First, provide me this nominal cash flow, then we will take it up with the discounting. So nominal revenues are there. The costs are what? 6 lakh and 8 lakh. Then nominal cost is going to discount at what? 10, 12, 10, 9, and 8. This is 6 lakh into 1.12. This is 8 lakh into the rate is 10%, so 1.1. This into 1.09. And this into 1.0. The nominal cost. We have the nominal revenue. We have the nominal cost. Nominal revenue and nominal cost. So now we can obviously get nominal revenue minus nominal cost into tax rate into 1 minus tax rate, and then add to it depreciation into tax rate. So depreciation amount. What is the amount of depreciation? What is the amount of depreciation, guys? The amount of
1 lakh
depreciation.
60.
Huh?
4 lakhs, sir.
4 lakh, right? Annual depreciation is 4 lakh, yes. Can definitely say this is 13 lakh 20,000 minus 6 lakh 72,000. This multiplied by 0.4, because 60% is what the tax is being said. Yeah. This is multiplied by 4, 0.4, and plus on 4 lakh, you're going to save 60% of that as tax. So this happens to be what? Four lakh 99,200. Okay, that's your nominal cash flow, nominal annual cash flow. Okay, then calculate the same way for the second, third, and fourth. Calculate the same nominal cash flows, nominal annual cash flow for second, third, and fourth year.
Sir, nominal cost, I got some different values, sir.
Those are different values coming.
Cost. Oh, I think, yeah, I just missed out on it. Yeah. That's into 1.12 and then further multiply this. Then this should be also into 1.12 into 1.1 into this 0.12 1. Okay. Are these numbers accurate now?
Yes, sir.
Yes.
Yeah. Perfect. Just calculate the nominal annual cash flows, guys. Calculate the nominal annual cash flow by using the same formula that we have specified here.
Sir, first year I got 419,200.
Right?
Yes, sir.
Sorry.
Okay, correct.
In second year, sir, 517,200.
Second is minus the cost to 0.4 plus four lakh and 6. Are we getting this nominal annual cash flows, everyone?
Yes, sir.
Yeah. Now we can get the NPV also. NPV will be, let's say, year nominal cash flows. Year 1, 2, 3, 4. Nominal cash flows is these numbers. And then we are going to discount it at what, 10%? In year 0, we are investing what, 16 lakhs. PV factor at percent. 1. That is 1 divided by 1.1 raised to number of years. And
Sir,
then
my
present value is
NP nominal annual cash flow is not matching
which one?
last year, fourth year.
Matching. Revenue and cost is matched.
Both are matched. Let me check, recalculate. I think I had done some mistake here.
Just check. Because I think I applied formula here, so shouldn't be any error creeping in the calculation. Just multiply the nominal cash flows.
Thank you, sir.
Okay. So our NPV is like 13,947. Great, everyone. Getting these NPV numbers, just verify.
Yes, sir.
Okay, perfect. Okay, so that's case scenario B. Case scenario. Now let's look at third case scenario. Again, you take the lead, start with the calculations, and then I'll show you the solution, or we'll work out the solution. Come, guys, let's start. Question case scenario number 3. Just read it and try to solve them. You are going to do it, or shall I start? Eligible from your end, or should I begin? Yeah, guys. Eligible from your end? Shall I give it a start?
Sir, can you explain it, sir? We tried, but
Okay. I was expecting that anyways. Okay. So XYZ Limited is a mid-sized manufacturing company that produces industrial equipment. The company is considering new investment project, a state-of-art automated production line, which is expected to improve production efficiency. Details of the same project are as follows. The initial cost of project is 10 lakh. Sale price per unit is 60. Cost per unit is 40. Sales volume is 20,000 units. 30,000 units and 30,000 units. Applicable discount rate is 10% per annum. From the information given above, choose the correct answer to the following questions. We have initial cost, sale price, cost. There's no taxation and all, just the discount rate. The first question, sensitivity analysis, helps us to identify. This should be manageable, guys. So which one do you think out of the four?
C.
Option C.
Degree to which change in each variable? The degree to which a change in each variable affects the NP. Then second question. The sale price per unit so that the project would break even with zero NPV shall be approximate. So you want to calculate the sale price at which the project is going to be, breaking even. Okay. Now, let us first try to get this question there itself. Limited is a mid-sized manufacturing company that produces industrial equipment. The company is considering a new investment project, a state-of-art automated production line. So you want to calculate first initially the NPV. So we have to get the cash flow after tax. That's going to be 60 minus 40. In fact, I need to get the cash flow in each of the years, right? So we have year cash flow. So year 1, 2, 3. We know the units. Units are 20,000, 30,000, 30,000. And cash flows are simply going to be, 60 minus 40 into the units. So this is 60 minus 40 into 20,000. Okay. These are the cash flows that we have. Simple. Then we take the present value factor at the rate of 10%, 1 divided by 1.1 raised to 1. PVs. Cash flow multiplied by the PV factor. So 1310293. Lakh 10,293. That's your cash flow. From that, we are going to subtract investment. So the investment value is 10 lakh. We get the NPV as 3,10,293. We have the sale price per unit so that the project would break even with a zero NPV shall be approximately. Sale price per unit so that project would break even with zero NPV shall be approximately. So you want to know what should be the sale price which will lead the project to be having a zero NPV. So I need to change this sale price so that the NPV turns out to be zero. So how do we go for this? For identifying the numbers. We want to know what should be the sale price so that the project would be having a break-even point as NPV with 0. So we'll say, of course, at NPV, or I can say at NPV equal to 0, PV of inflow should be equal to PV of outflow, right? So PV of inflow will be what? 20,000 into sale price minus 40 divided by 1.1 plus 30,000 into sale price minus 40 divided by 1.1 raised to 2. Further adding 30,000 into sale price minus 40 divided by 1.1 raised to 3. This is equal to investment of 10 lakh. So I just need to solve this equation to get the value of the sale. So can you solve this equation? You can simply solve this equation, guys.
Okay, sir.
Yeah, solve this equation, give me the value of S or the sale price at which NPV is going to be 0.
$55.26 I got, sir.
55.26. Okay. Well, you can solve this as 20,000 S, or you can do it this way. 20,000 divided by 1.1, right? This into S minus 40 plus 30,000 divided by 1.1 raised to 2. This into S minus 40 plus 30,000 divided by 1.1 raised to 3 into S minus 40. From this, we can take S minus 40 common. Say it is 181.8 plus 24,793.4 plus 22539.4. This is equal to 10. S minus 40 into this one plus this should be equal to 10 lakhs. So we say S minus 40 is equal to, and S will be equal to this plus 40. So answer is 55.2638.
26. Yes.
Yeah, 50. The option is what? Option D, right?
Yes, sir.
Correct option is option B. Perfect. Then cost per unit, so that
44.74.
the project would break even with 0 NPV shall be approximately
44.7.
44.74.
74.
How did you get it?
Here we are assuming cost as X. I
Okay.
mean,
And then same way solving
yes.
it as an equation.
Yes, sir. 60
Right.
minus X into.
Okay. Okay. So cost is going to be
He has subtracted 6 from 60, this figure, 16. He has subtracted from 6, this 60, 15 point something that we got now. So she's calculating it as 44, I think.
60 is our sale price. So there is no change in the sale price, but we want to see what would happen to the NPV when there is a change in the cost. So you want to increase the cost, right? The cost is currently what? 40. So I want to increase the cost so that the NPV is 0. So you can solve it simply by forming this sort of equation only, right?
Yes,
Or
sir.
is there
Same
any
we will get. Yes, my
same way to
60
say?
minus X is equals to.
Yes. So the same equation, we can write it as this is going to be 60 minus cost. This is also 60 minus cost. This is also 60 minus cost. So on solving this, what is the value of the cost? This should be equal to, my bad, 10 lakh. So as you said, solving this cost gives us 44.74, right? Solving this
Yes, sir.
equation for C, it is 44.74. Okay, correct.
We can do it reducing 15 from the earlier figure of 16. So we need not calculate
Reducing
it.
15.
50, 6 from 60. If we subtract 15, we had calculated earlier. No?
What have we
15.
calculated? 40 is 15.26. Yeah, I mean, yeah, this could be also a situation where you say that the spot minus 40 is 15.26, right? So I'm saying let's say, and this is what spot minus 40 is this number, spot minus 40 is this number. So if I want to know what is the cost, I can definitely say that this 15, to see what is the cost. So let's say 60 minus the cost, the new cost should be equal to this 15.26. So I can say that the cost is 60 minus this. So 44.74. Yes, you can also say that way. That since the spot, I mean, the sale price minus 40 was supposed to be having a profit margin of this 15.26. So when the profit margin is 15.26, then you have the NPV as 0. Oh, profit margin of 15.26 gives the NPV as equal to 0. Right, so profit margin of 15.26 gives our NPV of the project as 0. The profit margin is 15.26. It gives the NPV as 0. So we can say, since we have this 15.26 as the margin, so we can say the cost, if increased by 15.26, will cause NPV as equal to 0. Simple. So when your profit margin is 15.26, sorry, cost profit margin is 15.26, which gives you the NPV as 0. So we can say, of course, 60 minus the C is going to give you 15.26. So we want to see what the cost. That's going to be 60 minus the given numbers. Okay. So option is 44.74. We want to ensure that with the profit margin is 15.26. So for that, against revenue of 60, your cost should be 44.74. Okay. Are we clear? Third one, guys. Third one. Okay. Fourth question. Overall, dash in sales volume will lead the project to break even with 0 NPV. Overall, what percentage change is going to, in the sales volume, is going to cause the fact to be having a 0 NPV? Overall dash in the sales volume will lead to the project to break even with 0 NPV. How do we calculate this percentage fall that is needed? So we know the original NPV is 3,10,293. So what percentage change in the sales volume is going to cause the NPV to be 0? When is it going to cause the NPV to be 0? $13,10,293. This is the amount of cash inflow that we have.
31, sir, 31.02.
The units are going to have an impact on overall thing. So requisite percentage, like NPV currently it is 3,10,293. The NPV is 3,10,293. Okay. PV of inflow is this plus 10 lakh. Then, so this is like, we want to know what is the percentage change that we see in sales volume will cause the project to break even with 0 NPV. So what should be the percentage change so that NPV becomes 0? Now, of course, the units are something, which is going to impact on each of these cash flows. So some percentage change over here is going to be causing the NPV to be 0. Now, what should be that percentage change? We want the NPV to be reduced to 0, right? So we can get this answer by simply percentage change in units required for zero NPV. So this is going to be 3,10,293 divided by 13,10,293. So that's going to be 23.68 because NPV is 23.68 percentage of total inflow. So if we just remove 23.68% of PV of inflow, which is due to the units, that will obviously cause the NPV to be becoming 0. You can just verify here. Let's say this entire part. Let's say each of these units are going to be changed. Okay, these units are, let's say this into 1 minus 23.68%. See, it's almost like NPV is almost 16. So which is now maybe rounding up is not considered. But if I just consider this, link it appropriately, and take the full amount of decimals, we can see NPV is 0. So percentage change in units required for 0 NPV is simply NPV divided by PV of inflow. Divided by PV of inflow. Okay, so the correct option over here is option B. Fall of 23.68. Okay. Then, fifth question.
Sir,
Yeah.
in that how we can say whether it is a fall or increase?
NPV is going to fall, right? If you increase the units, NPV will be increasing. It will become more positive.
Yes,
Got
sir.
it?
Yes, sir.
Yeah.
Yes, sir.
Okay.
Yes.
Right. The next one. A dash in the initial outlay will lead to project to break even with 0 NPV. Now, as a percentage of initial outlay, you can say NPV. This NPV of inflow is 10 lakh. So what is the percentage change? Percentage change in initial outflow for 0 NPV. So this will be 3,10,293 divided by 10 lakh, which is 31.03%. Percentage change is 31.03%. So of course, this is going to be an increase. I mean, when your initial outlay increases, then your NPV is going to fall. When your initial outlay increases, then your NPV is going to fall. The option is option C. Did you all get it, everyone? C. So when you want to see the percentage change in units, you divide the NPV by the PV of inflow. And you want to see what's the percentage change in outflow, then percentage change in the initial investment, then you divide it by NPV by the outflow. Got it?
Yes, sir.
Very good, guys. Case scenario 3 is done, guys. So let's just take a break right now of around 15 minutes. Right. And then
So these scenarios are given where, sir?
which scenario?
These case scenarios.
They're there in the case scenario booklet of ICAI. We have the case scenario booklet, right?
Yes, sir.
There we have this.
Thank you.
Yeah. Okay, so let's take a break of 15 minutes, guys, and then we'll come back and take up the remaining case study, which is case study number 4. Okay, let's take a break, guys. Right, guys? Yes. Okay. So fourth case scenario, XYZ Limited wants to invest 8 lakh in new unit. Okay, so they want to invest 8 lakh in new units. The project is expected to have a useful life of 4 years with no salvage value at the end of its life. Annual depreciation. Annual depreciation is 2 lakh. Projected revenue and cost for the project, ignoring inflation, are as follows. So when you say you're ignoring inflation, what are these numbers? I mean, what are these cash flows? Real cash flows or nominal cash flows?
Real.
Anyways, what are the cash flows? Real cash flows or nominal cash flows?
Real.
Real cash. Okay. Have the revenue and cost given to us. XYZ Limited is also subject to a corporate tax of 60%, and the cost of capital for the project, including inflation premium, is 10%. So this 10% is again obviously including the inflation premium. So that's the nominal cash flow, nominal rate. Depreciation provides a tax benefit, and inflation rates for revenue and costs over the project's lifespan are as follows. We have the inflation for revenue and cost, and then we have to calculate what is the depreciation tax benefit for the year, an inflation adjusted revenue in year 2, total cash flow in year 1. So all these things have to be done, but let's solve it like we did the case scenario 2. Let us first solve it fully. Get the NPV, guys. Get the NPV, and then we'll look into the options. Then we'll look into the questions. Try to get the NPV, guys. Calculate the NPV. Get the NPV first, guys. Solve it fully, just like we did this one. Just like we did this one. This way. We have to solve it fully, get the NPV, and then we can answer each of the questions separately easily. So first, try to get the NPV fully, guys. Will you be able to do it? Calculate the NPV. Was the same method. I mean, convert everything into nominal and then discount it using the nominal rate. Can I expect you to do this? I mean, are you manageable? Will you be able to solve it? Yes. It is similar to question number 2. Yes. Yeah. Okay. Go ahead, guys. Go ahead. Calculate it quickly, then we'll look into the questions.
Sir, NPV is 1,06,942.
6,942.
1,06,942.
The final NPV. Okay, let me just do it over here. So the revenues that we have is what? 6 lakh, 7 lakh, 8 lakh, 8 lakh. Just verify the nominal revenues. $1.1. Are you getting this nominal revenues? Just verify the nominal revenue numbers.
Yes,
Yes,
Cost
sir.
is, yes.
Yes, sir.
Cost is 3 lakhs. Back. And just look at the nominal costs.
Yes,
Are the
sir.
nominal costs?
yes, sir.
Yes, sir.
Then finally we have $6,60,000 minus 36,000 into 0.4 into plus 4 lakh into 0.6. So look at the annual cash flows, nominal annual cash flows. Yeah, depreciation will change. Depreciation is 2 lakh. So are these your nominal cash flows?
Yes, sir.
Yes. Okay. Then, so here nominal cash flows and investment is how much? 8 lakh, right?
Yes, sir.
NPV is 1,06,987. Perfect.
Yes, sir.
Okay. Now, depreciation tax benefit for the project per year shall be, what will you answer for this? 2 lakh into 0.6, right?
1,20,000.
1,20,000. Option A is correct. Then, second thing, inflation adjusted revenue in year 2 shall be
839,300.
adjusted
Option
revenue in year
B.
3. 839,300. Yes. Total cash inflow in year 1 after adjusting for inflation and tax benefit is
258,600.
cash inflow in year 1 after adjusting for inflation and tax benefit on depreciation. Tax benefit on depreciation.
249,600.
Sorry, 249?
249,600.
Yes, 249,600. Inflation adjusted cost in year 2. Cost inflation adjusted was 4,92,800.
492,800.
See? One present value of, sorry,
No, sir. It's not.
present value of cash flow for year 3 shall be approximately. Present value of cash flow for year 3, 2,13,604. Option A. Because it's closer to that. Since you have taken up to full decimal, there may be some discrepancy, but yes, option A is accurate for fifth question.
Sir, that is for year 2, no, sir?
For the
Year 2.
yeah.
Third year.
Oh, sorry. Year 3, no? Yes, it is 239,949. Just we are getting it as 2,40,000. Yeah, so option C. Okay. Did you get it, everyone? Yeah. Okay.
Yes, sir.
Now, let me just come up with more MCQ. Yes. Case scenario for discussion. हाँ just share कर रहा हूँ. Yeah, let's take up this question for discussion now, guys. Can you see the question is? Yeah.
Yes, sir.
Okay. See, ALM Limited is considering taking up one of the two projects, Project A and Project S. Both are having a life of both having the same life, require equal investment of 80 lakh each. Both are estimated to have almost the same income. As the company is new to this type of business, the cash flow arising from the projects cannot be estimated with certainty. The cash flow arising from the projects cannot be estimated with certainty. An attempt was therefore made to use probability to analyze the pattern of cash flow from other projects during the first year of operations. This pattern is likely to continue during the life of these projects. The results of analysis are as follows. So project K and S, we have got the 5 cash flows and their respective probability. We have to calculate the variance, standard deviation, coefficient of variance for both projects, and then which of the two projects is riskier. So let me just do it for project K, and then you can same way replicate for project S. We have probability. We have cash flows. So probability 0.1, 0.2, 0.4, 0.2, 0.1. And the cash flows are 11, 13, 15, 17, 19. So how do we calculate the variance? So for variance, first I need to calculate the probability into cash flow, which will give us the expected cash flow. Expected cash flow will be summation of probability into cash flow. The total of this, right? So let's try to calculate the total and give me the number of probability into cash flow base. Yep. Yep.
15, sir.
How much? 1.5?
15, yes, 15.
Yes.
15. Okay. 11 into 0.1, which is 1.1. Then 13 into 0.2, which is 2.6. 0.4, which is 6. 17 into 0.2, which is 3.4. 19 into 0.1, 0.9. So we have 1.1 plus 2.6 plus 6 plus 3.4 plus 1.9, which is 50. So we got the expected cash flow, which is 50. Now, after expected cash flow, I need to calculate the variance and the standard deviation and coefficient of variance. So for variance, I need to subtract cash flow minus expected cash flow, right? Then we'll have to do like probability into cash flow minus expected cash flow square. And I need the total of this. So calculate and give me the total of probability into the deviation square.
$4.8.
4.8. Okay, cash flow minus expected cash flow. We have 11 minus 15 and minus 4 minus 2 0 2 4. So we have 4 square 16 is 0.1 into 16, which is 1.6. 0.2 into 4, which is 0.8. 0.2 into 2 square. Point 1 into 4 square is 16. So 1.6. So if we add them all, 3.2 plus 8, and then it's 4.8, right?
Yes.
So
Yes.
variance of cash flows is 4.8. If I ask you what is the standard deviation, what is the answer for that?
2.19.
0.19.
Going to be square root of 4.8. Square root of 4.8 is how much?
2.19.
0.1. Then also the coefficient of variation. Coefficient of variation is standard deviation upon expected cash flow. Standard deviation is 2.19 divided by 15.
0.14.
0.146.
0.14. Or you call it as 14.146, right? So 14.6% is also what you can say, coefficient of variation. This is for the project K. Now, can we calculate similarly for project S? Yep. Can we calculate similarly for project S?
Yes,
Yes,
sir.
sir.
Sure. Give it answer and then tell me which of these two projects are riskier.
Sir, coefficient of variation is 26.83.
26.83
Yes.
for project S.
Yes, sir.
Okay. Just wait, let me just recalculate and check it. Probability and the cash flows. We have cash flows are probability 0.1, 0.5, 0.30, 0.25, 0.17. Cash flows are 9, 13, 17, 21, 25. So first we need to multiply probability with cash flows and then take a total. It's going to be what? 0.9, 0.25 into 13, 3.25, 3 into 17, 5.1, which is 5.25, 2.5. So if we add them, 0.9 plus 3.25 plus 5.1 plus 5.25 plus 2.5. So is expected cash flow 70, everyone?
Yes, sir.
Yes, sir.
Have cash flow minus expected cash flow. So 9 minus 17 minus 8, 13 minus 17 minus 4, this is 0, this is 4, and this is 8. And then we say probability multiplied by cash flow minus expected cash flow square. And we add. So probability is 0.1 into this 6.4 minus 0.25 into 4 square, so 16 into 0.25, that's 4. 0.3 into 0 square, which is 0. 0.25 into 4 square. 16 into 0.25, 4. And 0.1 into 8 square, which is 6.4. So we get the variance as what? Add them all.
24.8.
20. 6 plus 6.
20.8.
20.8.
20.8, yes.
So variance is 20.8. Standard deviation is square root of 20.8.
4.56.
5607.
4.56. And then coefficient of variation is 4.56 divided by 70.
17.
How much is it?
0.268.
0.267 or
268.
equal to 26.7%.
2683, sir.
683. Okay, so 26.83. Okay, 26.83%. Okay. So which of these two projects are more risky, guys? Project K or Project S?
S is risky.
S is risky.
S.
S is riskier, correct. It's having a higher coefficient of variation. Right, guys?
Yes, sir.
Okay. Let's take up some independent MCQ questions. Let me just share the screen with you. So, ऐसे साइड में रिवॉल्व आपके और क्या और मैं और okay. So now let us go for the MCQs based on this. I'll just share the MCQ. Okay. Can you answer this first one? The first one, which is the correct option, is calculate and give me the answer. Initial investment 50 lakh, it is expected to generate a annual after-tax cash inflow of 12 lakh perpetually. Unlevered cost of equity is 12%, and the firm plans to finance 40% of the project with a rate of 10% interest. Corporate tax rate is 30%. So we have to calculate the adjusted present value. So how do we calculate the adjusted present value? It is simple. Answer is C, because we first calculate the base case NPV, which would be 12 divided by 0.12, which is 100. Okay. Then we say that unlevered NPV, which is 100 minus initial investment, which is 50. Then we calculate the tax shield. The tax shield will be 50, being the amount of investment. Of that, 40% is going to be funded by tech, right? And the rate of interest is 10% into 0.3, which is the amount of tax saving every year. Then we divide it by 0.1. So that's going to be 6 lakh. The adjusted present value is 56 lakhs. Right? So tax shield is going to be computed. Rather, this is present value of tax shield. So 50 lakh is your normal unlevered NPV. On that, we have a tax shield benefit of 6 lakh. So that gives the APV as 56 lakhs. Adjusted present value is 56 lakhs. Okay. Did you get this, everyone?
Divided by 0.1, from where we have
That's the
taken this
rate of
10%?
interest, right? Rate of
Okay.
interest. So dividing it by cost of debt. Tax saving divided by cost of debt, which will give you the present value of all the future tax savings. Okay. Then next question. Try to answer the second one. This key project has an expected cash inflow of 20 lakhs per year for 3 years. Initial investment is 45 lakh. The risk-free rate is 6%. Market return is 14%. Project beta is 1.5. So using CAPM based discount rate, what is the NPV over here? First, get the risk adjusted discount rate using your CAPM model. Say that our device cost of equity after taking into account the project beta part is risk-free plus beta into RM minus RF, which is 6 plus 12, that's 18%. You calculate the PV factor for 3 years at the rate of 18%. That's approximately 2.174. And then present value of inflow, it will be 20 into 2.174, which is 43.48. So ultimately, NPV is going to be 0.48 minus 45 lakh, which is equal to 1.52 lakhs. So I think there is some issue with the option. Yeah, it should be making this 1.5 lakhs or 1.52 lakhs. That's the option B for you, or option A, sorry. Okay. Then let us look at another case of this one here. Look at this last MCQ for the day, which is machine A costs 5 lakh, life is 5 years, salvage 50,000. Machine B costs 7 lakh, life is 8 years, salvage 80,000, cost of capital 10%. Which machine is going to be preferable under equivalent annual cost method? So we have to calculate the equivalent annual cost. Get the equivalent annual cost over here. What will be the equivalent annual cost? We have just the initial investment and there's a salvage. So how do we calculate the equivalent annual cost? So equivalent annual cost for A, it is going to be present value. Sorry?
So it is present value we have to calculate.
Yeah, 5 lakh plus 5 lakh is anyways the present value. I just need to subtract this 50,000 divided by 1.1 raised to 5, which is equivalent annual cost. I mean, this needs to be further divided by present value annuity factor at 10% for 5 years. Percent for 5 years. The equivalent annual cost over here. This divided by, what's the present value annuity factor at 10%? 1 divided by 1.1.
$3.79.
Point
3.791.
79. It is this number, and same way you can calculate the equivalent annual cost for B. Equivalent annual cost for B.
Sir, how we got that 4,68,953?
4,68,953.
953.
That's initial 5 lakh minus present value of salvage.
Okay, yes, sir.
Then for B, it is going to be initial investment is 8 lakh, right? 7 lakh, sorry. 7 lakh minus 80,000 divided by 1.1 raised to 8. And this is also going to be divided by the PV factor for 8 years. So what's the correct answer? I mean, give me the PV annuity factor at 10% for 8 years. Present value of annuity factor at 10% for 8 years. What is this number?
5.335.
Okay, so 124,213. So which one of them is having a lower equal annual cost? Option A. Machine A is going to be preferred. Machine A is going to prefer because it is having a lower equivalent annual cost. Okay, fine. So with that, we are towards the end of our today's session for revising the advanced capital budgeting. So we have covered quite a good number of numericals and also case studies. And at the end, we did have some independent MCQs also for discussion. So thank you very much, dear students, for having a patient listening to me. And we'll meet up again next time with a new topic for the revision purpose. Thank you.
Thank you, sir. Thank you.
sir.
Thank you, sir.
Thank you, sir.
Sir, you're on mute.
Thank you, Jagbanduji. You have covered my portion. Okay, saying so. Thank you very much for covering this, and just share my our telephone number as a custom. Just write down it on a. So, student, yeah, it is already there. So, student, today we have covered the topic chapter number 3, that is advanced capital budgeting. So in this, while Jagbandu sir was discussing last independent MCQ, so if you recall that the same topic has also been covered in your AFM paper at intermediate level, where you have to compare the two projects with having a different project life. Okay, so it is the same here, only except the difference is that here we are using the same concept for replacement of asset by computing the equivalent annual cost there. Okay, so I hope this topic must have been clear to you. Now, in the next class we shall discuss the new topic. So if you have any query, you can send us a mail or you can contact us over the telephone. Thank you and have a nice day. Thank you, Jagbandu sir. Thank you very much for sparing your precious time and then take the student on this topic. Thank you very much.
My pleasure. Thank you.
Thank you. Have a nice day.
Thank you, sir.
Thank you, sir. Thank you all.